Hey everyone, welcome back to Corporate Decoder. Today MarineMax Inc. just dropped their 10Q filing, and I'm seeing some big shifts in their business that you need to know about. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company's revenues are down, but their profits are actually way up, and there is a very interesting reason why. Alright, so today we are diving into MarineMax, also known as HZO, their quarterly report covering the period up to the 30th of June 2026. MarineMax is a huge player in the boat and yacht world, calling themselves the biggest recreational boat and yacht retailer. Marina operator and superyacht services company out there. They have a ton of locations, over 120 if you can believe it. Now, when we look at their financials, there is a clear story unfolding. For the 3 months ending in June 2026, their revenue was around $611 million. That is actually down from about $657 million in the same period last year, 2025. So on the surface, things look a bit slower. They reported a drop in comparable store sales, which means the stores they had last year are selling less. They point to a tough retail environment, economic uncertainty, trade policies, and even the Iran conflict as reasons for this. But here is where it gets interesting. Their gross profit actually went up for the same 3-month period. Gross profit jumped to about $218 million from around $199 million the year before. And even more crucially, their gross profit as a percentage of revenue shot up from 30.4% to over 35%. What does that mean? It means they are making way more profit on every dollar they sell. They attribute this to a shift towards their higher margin businesses and some tariff refunds related to past boat sales. This trend continues over the 9-month period as well. For the 9 months ending the 30th of June 2026, revenue was about $1.64 billion, down from $1.75 billion in 2025. Again, a revenue decrease. But again, look at the profit. Gross profit for those 9 months increased slightly to $559.8 million from $558.8 million the previous year. And the gross profit margin improved significantly from 31.8% to 34.1%. This is a really positive sign for the company's ability to manage costs and pricing power. Now, selling, general, and administrative expenses, which are basically the costs of running the business, did go up. For the 3 months, these costs rose to $180.9 million from $172.1 million. They say this rise is linked to that shift towards higher margin businesses, which naturally have a higher expense structure. For the 9-month period, these expenses climbed from $469.6 million to $506.9 million. This rise is also tied to changes in how they value contingent liabilities, which are basically future payments they might have to make from past acquisitions. Let us look at their debt situation. They have a significant amount of short-term borrowing, mainly for their inventory, called the floor plan. As of the 30th of June 2026, that was over $608 million. This might sound like a lot, but it is a standard part of their business model to finance a large inventory. Their credit facility was recently updated in June 2026. This new credit facility provides them access to over $950 million for their floor plan, and a $150 million revolving credit facility. The interest rates are tied to SOFR, the secured overnight financing rate, with different margins depending on the type of borrowing. It is good to see they were in compliance with all their loan covenants as of June 2026. Their long-term debt situation is also detailed. As of the 30th of June 2026, their total long-term debt was around $364 million. This includes various mortgage facilities and term loans. They have also disclosed the fair value of these loans compared to their carrying value, and for most, the fair value is quite close to the carrying value, which is a stable sign. A major point in the report was a goodwill impairment charge in the prior year. In fiscal year 2025, they had a non-cash charge of nearly $70 million related to their product manufacturing segment. This means they judged that the value of that part of their business was not as high as previously recorded. Now, let us talk about what is driving that improved profitability. A big part of the story is how they are valuing contingent consideration liabilities. These are essentially future payments owed from past acquisitions. In 2025, they recorded a gain of over $25 million related to changes in the fair value of these liabilities. In the first 9 months of 2026, they recorded a smaller gain of about $0.3 million. This gain is recorded in their operating income, boosting their bottom line. The company also provided a breakdown of their revenue by segment. Their retail operations segment, which includes selling boats and related services, makes up the vast majority of their revenue, about 85% in the last quarter. The product manufacturing segment, where they build brands like cruisers, yachts, and Intrepid powerboats, is much smaller, contributing around 4.8% of revenue in the last quarter. Let us dig into the numbers for the segments to understand that profit increased better. Looking at the 3 months ending the 30th of June 2026, retail operations brought in about $37 million in operating income, while product manufacturing actually had a small loss of around $554,000. This is a stark contrast to the 3 months ending the 30th of June 2025, where retail operations had an operating loss of over $72 million in the product manufacturing segment, which was heavily impacted by that goodwill impairment charge. This shift in profitability between segments is key to understanding their overall financial health. They are getting more efficient in their retail operations and have absorbed that manufacturing hit. Now, for a bit of context, recent news shows there is interest from big players like Blackstone and Donorail in MarineMax, with their stock surging on those reports. This suggests that despite revenue dips, the market sees value in their improved profitability and strategic position. So, what is the big picture here? MarineMax is navigating a tough market with declining revenues, a common theme for companies dealing with consumer discretionary spending and economic uncertainty. However, they are doing a remarkable job improving their profitability by focusing on higher margin businesses and likely cutting costs shrewdly. The goodwill impairment last year in their manufacturing division was a significant hit, but they seem to have moved past that. Their strong credit facility provides them with the liquidity they need to manage their inventory, which is crucial in this industry. The recent stock surge on potential acquisition interest is also a very positive signal from the market. What I am watching closely is whether they can sustain this improved profit margin, as revenues might continue to face pressure from economic headwinds. Their strategy of shifting towards higher margin services and products seems to be paying off, and that is a smart move in any market. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. For more deep dives like this, make sure to subscribe and hit that notification bell. Let me know your thoughts in the comments below and join the conversation on our Discord server, linked in the description.